whenever you are ready.
Well, good evening, everybody. Welcome to our webinar tonight. My name is Sean van den Berg. I head up client education at PSG Online. To get started, let me just throw out two questions. How many of you novices feel that it's a challenge to get started? Okay, I always get this question posed to me, and also I find that many people will feel exactly the same way. So the other question is, how many of you would like to know how to select a share as a trader or how to select a company as an investor? So the solution is by having various options available to you and helping in the share selection process or the stock picking process, that will enable you to fine-tune a watch list and obviously get to a stage where you have a list of potential winners. So that is my objective today with this webinar. Okay. So the idea with or the agenda as such is we're going to learn about three things. We're going to work backwards. So first of all, we're going to start with talking about a portfolio of shares and then how to select a share as an investor or a company as an investor using fundamental criteria, and how to select a portfolio as a trader using technical criteria. Okay, so that's what we're going to discuss in the next few minutes to get started. Okay, so let's move into it. If you ever go to a financial advisor as a novice investor, the advice most of the time you'll be receiving is to create a diversified portfolio of unit trust and exchange traded products. Okay, now I presume that most of you listen to this presentation because you'll be directly involved in the stock market. But many of novice investors don't have a lot of funds to get started with. And the challenge is if you had to go buy one share, and it's much riskier than buying a ETF. Remember, ETF, exchange traded fund, is through one share you have a basket of shares. Okay, so that's a challenge for most private investors or most novice investors. So the idea is, well, if you had to obviously buy into one share, the risk is much higher, but also the potential returns is much higher. Now, I'm just showing you since the beginning of this year, Sasol has gone up 20%, over 20%, where Satrix 40, which is the oldest ETF listed on the JSE, has gone up 11%. You can see where that potential returns go. But as I say, you're putting all your eggs in one basket, or your one egg in your basket. So the challenge is, or the solution rather, is to add a few shares, individual shares, and build up a share portfolio. And that's why I would say we're working backwards to the stage where you start selecting the criteria for the share. So you build a share portfolio. The idea is that you can maybe put 4 different companies, allocate 10,000 Rand or 10,000 Rand to 4 shares, 2,500 Rand into each. Then your cost as a percentage also is much lower. Okay. So how do we do that? Obviously, we talk about, first of all, we talk about portfolio management, and we talk about the portfolio structure. You can look at what they call the large cap stocks, the top 40 stocks. These are the blue chip shares, been around for a long time, good consistent management, good consistent results. And you can also look at what we call the next 60 companies or the mid-cap size companies. Also good quality companies. Obviously, they're slightly more riskier than compared to the big blue chip shares. And then anything not in the top 100, we at PSG consider as small cap stocks. And obviously, these shares are considered much more riskier because some of them are not so liquid or tradable. Okay, so it's out of these groups of shares that you'll structure your portfolio ultimately. Okay, we also talk about portfolio management and using what we call diversification to manage risk. So we talk about spread of your portfolio. So the idea is to spread it across all the different industries, and I've broken it down to financial, industrial, and resources and mining. And within those different industries, you want to choose between 3 and 5 different sectors, and out of those 3 or 5 different sectors, between 8 and 12 different shares. And that's ultimately what your share portfolio will be consisting of. Okay. So this is just a idea. If you had 100,000 Rand, you can allocate. If I bring in my little cursor here quickly, my spotlight. You allocate 50% of your funds, maybe to 4 large cap companies. Okay, so allocating roughly 12.5% per share. Okay. And then also the idea is diversified along the lines of industry. So these might be a financial share, that might be industrial share, that would be another resource stock, and that might be another industrial company. And allocate 40% of your funds to the mid-cap stocks. In other words, you're allocating 5% to 8 different companies. Okay, so you're allocating less funds to more riskier stocks. Okay, if you add it up, what's missing? We get 50 plus 40, we equal to 90. What's missing is maybe cash. And this is also might be part of your strategy to keep maybe 10% in cash. Why? Because what happens, if an opportunity comes along, you fully invested, now you have to sell one of your shares in your portfolio, and you'll be selling for the wrong reason. Okay. Obviously, over the period of time, you'll also be getting dividends, which is the income from the companies paid out in form of dividends, and you can also use that to add to the shares in your portfolio. Okay. But the point I'm trying to make here is the structure of the portfolio and the spread. This is where we ultimately want to get to. Okay. So that's what I meant when I said right in the beginning we're going to work backwards and from there. Okay. So there's two approaches to selecting a share. You use what they call a top-down approach, and according to the Investopedia website, this involves looking at the big picture. Look at the big picture first, and then from there chunking down. So we look at economic analysis, we look at the economy is doing well, and all the things that can affect the economy. Within that within the economy, we look at the best industry, where's the growth as such within that industry, the best sector. And as I say, we just chunk into smaller components, ultimately getting to the stage where we're looking at the individual companies. Now, this is ideally, a top-down approach is ideally for a trader, and they'll incorporate this into their trading system. Okay, that's what we call a top-down approach. As an investor, we use what we call a bottom-up approach. So this is where we de-emphasize the economic cycles and the market cycles, and we focus on the individual shares itself. And then from there, we look at everything we need to know about that company. Look at the products and services, but more specifically, its financial statements. And from there, compare it to its sector and maybe and compare it to its peers. This is what we call a bottom-up approach. And this is more the investor approach. And this is the approach we use at PSG Online, a lot to do with our value investing approach. Okay. So, how do we get started? Just some ideas for you. Start with an industry or company that you might know, that you may know. So, bottom line, you want to look at the health of the company. So, the value depends on the health of the company, and we're going to look at various criteria with that. So, a good place to start would be the companies that you are familiar with, the favorite brands. You know, all of us have cell phones. You might be with MTN or Vodacom. Okay, start with that. You might like to shop at Woolies compared to shopping at ShopRite or shopping at Spar. Okay. My background as such, I'm a restaurant manager. I used to be a Spur manager of Spur many years ago. That's how I first started. I started specializing in the sector I knew, and from there I diversified out. So that will help you put the company's earnings results or the earnings reports into context. Okay. Also, you want to avoid the hype, chasing the hot stocks, the companies that are in the newspapers all the time. Because there's momentum behind them, and those stocks will be flying up higher and higher. It might be too late to buy those stocks. You need to understand why a company is making money. Okay, so just be careful of chasing the hot stocks because you can get your fingers burned. Excuse the pun. Also know what kind of company you're considering buying into. A growth company, for example, those restaurant companies, the famous brands, the franchise group, those are growth stocks. They're growing very much higher than the average of the market. But you must understand that kind of growth compared to a normal established company, that growth company might be considered expensive. And we'll talk about how do we know it's expensive. We'll look at various criteria just now. But ultimately, one of the best ways of looking at opportunities is to look for undervalued shares. And this is used, the old way of looking at it is what we call price-earnings ratio. We consider any company that's trading on a PE below 10 as cheap, any company trading on a PE of above 20 as expensive. And you'll see in the next slide, in a few slides just now, where the market is trading at the moment. That's one of the first criteria to look at. Secondly, obviously, when you look at a company's PE ratio, you want to compare it to its peers. Is the share cheap or expensive compared to its peers? And you'll see some examples coming up just now. Cheap is not always good, and expensive is not always bad. Cheap can mean that the company is growing less or actually slowing down, whereas a company that's expensive is growing and people are willing to pay up more for that company. People buying those shares up because they expect it to be worth more later. So that's why I'm saying look at the value combined with the expectations of future growth or future earnings. Combine those two together as a criteria to buy shares. Okay. So yeah, I'm looking at the retailers. We're looking for Sheeny, Truworths, and Mr. Price. Okay. You see the price there? And let me bring my cursor back in again. The spotlight, most people say, whoa, Mr. Price is trading at 196 rand 67 cents. Remember, it's always in cents. And I might consider that is expensive. Word of advice, never buy a share just on price. You want to look at value. So when I talk about value, one of the first criteria would be to look at the PE ratio. As I mentioned just now, anything below 10 we consider cheap, anything above 20 very expensive. So in this scenario, Mr. Price is very expensive compared to its peers. Okay. Moving forward to the next slide. Yeah, we're looking at the graph now. This is looking at Mr. Price. This is just looking at the historical price over the last 3-4 years. And this is the PE ratio. As I say, we're trading around about 24. Very expensive. Compared to Mr. Price, to Truworths and to Truworths and to the Fashini groups, you can see the share price is coming off. This is on Truworths, whereas Truworths, the PE ratio, we're hovering about 12.5. The Fashini group as such, the share price is still high. You can maybe anticipate a pullback and profit taking soon, whereas the PE ratio relative to Truworths ratio is very, very similar. Out of the two, I would prefer Truworths because obviously it's cheaper, but as a starting point, you might consider looking at Truworths because it's already bottomed out. Okay, so even both those shares might be a good opportunity to look at. Here we're looking at the construction sector. Now, Aveng, for example, has a PE ratio of 19.2, where Group 5 and Wilson Bailey have PE ratio of 9.7 and 9.7, okay, respectively. They are considered very cheap relative to Aveng. Okay. So again, look at the graphs. There you can see Aveng's share price is coming down, but the PE ratio is still going up. But you must understand, if you look at historically what's been happening with Aveng has come off a very, very low base. So the price is down, but still very expensive. Okay. So Warren Buffett's got a saying, price is what you pay, and value is what you get. This is a classic example. Okay, so I still won't rush out and go buy Aveng. I'd rather look at a company like Group 5. You can see it's pulled back nicely, and it's trading on a PE of below 10, and Wilson Bailey trading roughly at about, what's that, 12.5, 12. Okay, so it's very, very cheap. So both these companies are trading at the bottom of the cycles on the price, and relative to the price-earnings ratio are considered cheap. Okay. So that's one of the old ways of looking at it. So we go one step further now. We're bringing what they call the PEG ratio. What is the PEG ratio? Again, if I bring my little cursor in here, at the bottom here, the PEG ratio, all it is the PE ratio divided by the HEPS growth percentage. So I'm taking the 12.3 divided by the 14, and I get a PEG ratio of 88. Okay. We consider anything between 35 and 75 on the PEG ratio as undervalued. Okay, so this share, for example, will still be considered a fair value, but it won't be. It's not undervalued. So anything between 76 to 126 we consider fair value. So that'll fit that category, what we call fair value. And basically that's where the market is right now. It's not much undervalued stocks available. In the construction sector, sorry, in the retail sector as undervalued. But out of the three, this will help me choose which stock to look at. So Fashini Group out of the three is the cheapest based on the PEG ratio. Going over to the construction sector, you can also look at Wilson Bailey as a very good growth stock. We say consider anything over 15% as very, very good. So they're growing its earnings by at least 17%. On the PEG ratio, is also considered very, very cheap, and that's what we consider undervalued on a 57 PEG ratio. Remember the PE ratio, 9.8, divided by the HEPS, that's how we get this PEG ratio. So that's one of some of the criteria you'd use to choose a share from a valuation point of view. Okay, let's move on. Okay, also very important to look at the health of the company. So we talk about quality of the company. Some people like to call it safety. Also, you want to look at consistent history. So you're looking at profitability, and we talk about the health of the company. We look at things like on the balance sheet. So it's very important to look at that. So people like to look at the top line. If the company is growing its earnings more than inflation, that will be reflected in the company share price. Because investors like to buy into companies that are making money. So that's what we refer to as the top line, growing its revenue more than inflation. Also, what's important to look at what we call the bottom line. And one of the criteria you can look at is a thing called profit margin. This is the difference between the revenue and the expenses, what we call profit margin. You want to see how the company is growing its revenue as well as controlling its costs. Okay, and that's where we talk about expanding margins. So anything above 5% plus, ideally 10%, that's a very, very good company you're looking at. Okay, they've got some fat to work with, and they can compete against their competitors. Okay. Also very important when I say look at the health of the company, it's very important to look at the debt. So this is where you look at the balance sheet. Obviously, the more debt the company might have, the more volatile the company's share price might be. Obviously, because more income would be going to paying interest and its debt payments. So it's important also to compare this company now that you're looking at to its peers. Are they borrowing an unusual amount of money compared to the industry and compared to the size of this company? Okay, so this is how you start sifting through the shares in your watch list. Also, I like to look at companies that are paying out dividends. Remember, it's not only just a source of regular income, it's also a sign that the company is in good financial health. So you want to look at the dividend history of the company. Is it increasing its dividends or not? Okay, so those are just some of the criteria that you can use to sift through your watch list to find the potential winners. Okay, if I use this analogy quite often, imagine you had a magic wand. What kind of shares would you like to invest in? If you had a wave your magic wand. I look at three criteria very broadly. I like to buy into companies that are undervalued, that are profitable, and that manageable risk. So here's very simple criteria. The average of the market is about 18 at the moment. That's based on the PE ratio. So any company trading on a PE ratio less than the average of the market, that's the kind of company you're looking at. And I mentioned just now, a PEG ratio below 75, we consider also undervalued. We talk about profitability. We spoke about operating margins just now, or profit margins. Another criteria you'd like to look at, return on equity. This gives you an idea of sustainability of the company's earnings. So I like to look at companies that are growing its return on equity at least 15% plus. Remember, it's consistent and sustainable. You don't want to see companies, 1 year it's 50%, next year it's 10%, next year it's 30%. I'm looking at consistently growing its return on equity because that will be reflected in the share price. The share price steadily going up. When it comes to risk management, we spoke about debt equity just now. I prefer to look at a thing called interest cover. It's how many times we can pay the interest bill out of earnings. And for a large cap company, we like to look at an earnings cover of 3 times. Yeah, as long as I can cover the interest bill 3 times out of earnings, we say it's manageable. For a small cap company, you might look at 5 times interest cover. Okay. On our website, we have a thing called the value filter. Based on those 3 criteria I just said now, we'll spit out a list of shares for you. You can see the PEG ratio, the first little column colored in here. I mentioned just now that most of the market is fairly valued, but this list of shares shows you these shares are still undervalued based on PEG criteria. These are companies growing its return on equity more than 15%, and there's your interest cover. Okay, so these are the shares that meet that criteria. So these are the kind of shares I'll put into my watch list now, and from there, go do further investigation. When I say do further investigation, you click on the share code. In this example, takes you to what we call the share info page. And from the share info page, I can read up more about the company. So this is your first starting point. Here's Wilson Bailey, we spoke about just this now. This is a one-pager written by our research department. They actually give a whole spiel about the company. There's a table compared to its previous reporting period. But this year, they give it a buy long term. And then you'll see on the recommendation why. So you can compare your analysis to our research department. It's a starting point. The best source of information for you as an investor is to actually get hold of the company's financials, go to the company's website, and download the PDF version of the company, and you go do your own analysis. Okay, so this is how you start selecting a share to buy. Okay, what not to do when buying a share. I mentioned just now, do not buy a share or price alone. Understand why a share has fallen. Okay, there's a lot of examples on the market. Let's use African Bank, for example. Obviously, investors don't like what's happening with the company, and that's why they're selling off the shares. You need to understand what will make a share turn around, what will make a share rebound. Those are the kind of things you want to look into. Okay, so don't just buy it alone because the share price has fallen. You think the share's cheap on price. Okay, it was 10 Rand, or its shares traded at 10 Rand, it was once upon a time at 40 Rand. Don't just go on price alone. Do some background investigation. Second, obviously, I just mentioned that you don't want to look at just at the analyst recommendations. Sometimes they are more biased towards buy ratings. But it's also very important to look at sell ratings. When an analyst gives out a sell rating, a red flag should go up. This should be an early warning. So be aware of those kind of things. Okay? Keep your eyes open. Okay? Remember, you use it. Don't just go blindly on the analyst recommendations, but you're going to compare it to your analysis to give you that confirmation as such. Don't be surprised by the volatility of a share. Remember, I mentioned just now, individual share can be more volatile than an ETF, like a Satrix. Okay, so you'll look at historically, and this is where the charts come in handy. Look at the 52-week, the highs the shares traded in the last year, and where the shares traded the lowest for over the last year. That gives you the range, and you can also see how wild those swings are. Okay. A lot of the shares now are breaking up above their 52-week highs, and those are opportunities also. So go look at historical price data just to see, give you a bit of perspective as such. But also very important, obviously from an investment point of view, you remember the strategy is a buy and hold strategy. You don't want to be in a situation where you want to sell for the wrong reasons, okay? But you also want to avoid panic selling because of the short-term moves in the market. I believe you document the criteria, document your reason for buying the share. If I buy into a share, my original decision has changed. For example, use the example of Cecil. I buy into the company because I believe it's an intellectual property company, not only an oil company. But I buy into it, and suddenly Cecil changes their business model. They instead of being involved in oil and that kind of stuff, they started to sell cell phones. I'm using an example. So my original decision to buy that share has changed. I might consider selling the share, or I might consider selling the share because it becomes overvalued based on our value criteria. On our value investor, it becomes overvalued, and then I might put a 20% stop loss. If it drops 20% from there, I'll get out. Yeah, a company might cut its dividend, and this might be a new trend. It might stop paying out dividends because it's conserving cash. That might be an early warning that the company's in trouble. I might consider selling the company then. Well, analysts downgrade. They also foresee that the trend for this company in the next few years is dismal. Whatever the case might be, you want to get out. Or the company's just forced to a certain level, you decide to get out. Obviously, technical trading is different to what we call investing. Trading, you're looking at more support and resistance levels and triggering stop loss. This is more pertinent for an investor. Okay. So we talk about trading and technical criteria. Depends on your time frame. How long you want to hold the share for? Remember, the difference between an investor and a trader is your holding period. Okay, the time period. We have three different styles of trading. We talk about a position trader. This is more what I call an active investor. You're holding the share from a few months to a few years. Okay, but remember, it's not a buy and hold strategy. So you're still taking advantage of the cycles in the market. Some of you might be what we call swing traders. This we hold from a few days to a few weeks. Okay, and then some of you might be what they call day traders. You're holding the position intraday. You're too scared to hold the position overnight. This is more for the derivative traders, the index futures traders, or as the currency futures. Okay, swing traders, you can do it with equities, but obviously you need much more funds available to make it worthwhile because of the costs. So that's why derivatives trading, like single stock futures and CFDs, all those kind of things are more applicable to the swing trader. Okay. So your trading style will depend on quite a few things. Obviously, the risk capital, your account size. The more funds you've got, the more flexibility you've got, the amount of time. Okay, the more time you've got, then you must become a trader. The less time you have, then rather be an investor. And obviously, when it comes to trading and things like that, experience is very, very important. That's why it's always important to use a trading simulator to gain the confidence in your stock picking abilities, but also have to test your trading style and your trading strategy. And I know that the JSC website has a facility where you can trade all those derivatives in a risk-free environment. Okay, so trading all comes down to also your personality. Not everybody's out to become a trader. You know, you lie in bed at night and you're worried about your money lying in your trading account, then trading is not for you. Okay, so it comes down to your risk tolerance. That's the relationship with that risk capital we're talking about just now. Okay. Again, if I had to use a magic wand, what kind of shares would I like to trade? I like to trade into the three criteria I like to buy into is that the share must be trending up. In other words, it must be in a bullish trend. And the criteria I use there is what I call cycle analysis. What cycle are we in? Primary cycle? Are we in the secondary cycle? Or, you know, are we in a long-term bull market, long-term bear market? Within those long-term primary cycles, on established, are we in a correction or rally? And one of the easiest ways to pick that up is use tools like moving averages. I like to use a 50-day and a 200-day moving average to help me determine are we in a bull market or bear market. So obviously in a bull market, if you're trading derivatives, that'll help you more to establish a long position. If you're trading below the 200-day moving average, we're in a bear trend, and I should be more on the short side. But from an equity point of view, obviously I want to be in a market that's trending up. Within that long-term cycle up, market still moves up and down. So we talk about overbought and oversold. Overbought at the top of the cycle, oversold at the bottom of the cycle. This is where you use various technical indicators now to help you in your timing, getting you as close to the bottom of the cycle as possible, and obviously getting you as close to the top of the cycle as possible. There are hundreds of different technical indicators. I like to use what they call a moving average convergence divergence, or more commonly known as MACD, because it works well in both markets, in a trending market and a trading market. So that's an oscillator that helps me determine where we are on the cycle. I also like to look at things like volume, and because volume confirms price action, but also volume that leads price action. So I use things what I call on-balance volume and volume price trend to help me also confirm what's happening with the cycles. Okay. And then what else I like to look at, I'm looking for shares that are very strong. In a trending market, I'm looking for shares that are outperforming relative to the average of the market. So the indicator I like to use here is what we call relative strength analysis, or it is dividing one data stream by another data stream. So as an example, I take SASL and I divide that now relative to the JSE All Share Index. So I want to see the trend is up. So you'll see in the next graph here, we're using the Fashini group. Here's those two moving averages I was talking about just now. The red line, bringing my little cursor, my spot line again. The red line is the 50-day moving average, and whereas the green is your 200-day moving average. So it's trading above the moving averages. That's why we're calling the long-term trend as bullish. Okay. This at the bottom is what they call MACD. It's an oscillator. It moves above and below a zero line. When it's above the zero line, we call it overbought. So it's the top of the cycle. Okay. So overbought, demand has pushed the share price up, where you'll see in the next slide, anything below this here, in this area is what we call oversold. So that would be the bottom of the cycle. That's our ideal time to get bought in. Okay, at the top of the cycle, not a good time to buy in. This graph also, by the way, it's highlighting what we call bearish divergence. The share price is making new highs, but the indicator is failing to confirm that. So it's a bit of an early warning. Watch out, the share will be changing direction soon. So you can anticipate some profit taking. Every single point on this graph is a buyer and a seller. Obviously, one of them is wrong, but you get the point now. There'll be more and more sellers coming to the market, taking the profits, and the share price will fall. So that's looking at the price of the Fashini group. This is looking at what they call volume price trend. This is a running total of volume, and also bringing in what they call percentage movement. So this is looking at volume accumulation. So there's a buying of the shares, and that's what's pushing the share price up. Okay, so we call that volume accumulation. You can see it's going to start to turn, and obviously as this comes back, you see this will start accelerating. And the bottom graph here is what we call relative strength. This is the Fashini group relative to the JSE All Share. So relative to all the markets, so we've had a bit of a downtrend. So that was where it's underperforming. That was going to stage it was outperforming. But of a sideways market at the moment. So this is what we call market performing. Okay, so you can anticipate it might be pulling back a bit, and we're going to a stage where we have a bit of market underperforming. I get excited when the market falls because it gives me a buying opportunity. Okay, so a bit of contrarian. Let's move on quickly on the next slide. Okay, here's Wilson Bailey. Here's the opposite now. So you can see it's below its moving averages. So this would be considered bearish. Okay, and it's also giving you bullish divergence. So out of the two shares, I like to look at Wilson Bailey. It might be an opportunity to recover. But obviously, I need the confirmation. I need to see it breaking up above a 50-day moving average and ultimately moving up, and those two moving averages crossing, confirming a upward movement. You can see volume distribution, confirming price action, and it's also more market underperforming. So I haven't really got any buy signals in both these shares. So these are the shares that I'll be having on my watch list from a trading point of view and waiting until such time I have buy signals, and then I'll be trading those shares. Okay. So exactly the same scenario as an investor, you'll create a watch list, and ideally a watch list using charts like this, and you scroll through the list until such time you get confirmation. Okay. So guys, I hope this has been beneficial to you. Just if you do a quick summary, start with your financial objectives. Ask yourself, are you an investor or trader? The best thing to do is to be both. Okay. And then work backwards. What kind of shares would you like to have in your portfolio? Okay. And we're talking about the three S's, with the structure of your portfolio, and then the spread, that's diversification. And you might want to bring in a stop loss, but from an investment point of view, I believe the diversification will help you cover that. So the three questions you always need to ask yourself: what must I buy? When must I buy? When must I sell? That is ultimately how you'd select a share portfolio. What share would I buy based on certain criteria? When would I buy based on certain technical criteria, as well as when to sell? Okay. And then obviously fundamental criteria, in a nutshell, the share must be undervalued, profitable with manageable risk, and from a technical point of view, must be bullish, oversold, and outperforming. Okay. That's in a very, very broad sense. Okay. In conclusion, you guys want to test our platform out, test out our research, you're welcome to go register on our website for 30-day free trial, see how the platform works, the simulator, see how the research works. There's no cost involved. Research platform, we have the value filters, company analysis of about 450 companies in the market. And this presentation, as well as the recording, will be sent to you. So it's ideal for you to review it. And any questions you have, you're welcome to send it through to me. Okay. Just quickly to heads up for our upcoming our education webinars. Over the next few weeks, we've got technical analysis coming up, how to develop a trading strategy, and then combine the two approaches, what I call fundamentals and technicals, what I call rational analysis. And then in September, we're talking about single stock futures and currency futures. I touched on it today. And then something very close to my heart is investment clubs. We do a webinar on that in November. Okay. But from my side, thanks a lot for your time on that. There's a lot of questions coming through. We'll answer them as we go along. Thank you very much for your time, and all the best. Bye-bye.